If you're saving, investing, and still wondering, am I doing this right? You really are in good company. Welcome to 5QIQ Financial Power-Ups from Trajan Wealth. We're here with the answers to the questions that you're asking to help you make every dollar work harder for your future. I'm your host, Jeff Jr., with fiduciary advisors Marti Bryant and Corbett LaDuke. And for this week's episode, we're going to talk what to watch for in a prospectus, how to tell if your CPA is actually proactive, explaining investing to young people, how to start building generational wealth, even if it feels a little bit late, and where to put extra money first: 401k, IRA, Roth, HSA, or a regular brokerage account. If those questions sound like your life, tell us about it at trajanwealth.com/5QIQ. So let's jump right in. So our first listener asks, what is a prospectus? And if I get one, what should I even look at? Money going out in fees is money that's not compounding for you. So asking questions is absolutely fair game. So what should they look at?
Well, certainly the first part that you look at, see if there's a load on the fund. Now,
So what's even a load?
So a load is an upfront charge that a broker typically charges to a client to invest in that particular fund.
A-share mutual funds have front end.
A shares, C shares are the second most common on that regard. And it's a higher, what's called internal expense or operating expense ratio. But typically when you get that prospectus, it's on like telephone paper. But if you're under 40, you probably have no idea what telephone book is. So the ability to look at that, and typically in the first couple of pages, it will tell you, what those loads are at least. And then if you go to about probably page 30, it talks about what's called the internal expenses on that. And to your point, Jeff, that's all money that's not compounding for your benefit. The upfront charge, Class
Expense
A's,
ratios,
5.75% is the very common. So if you put $100,000 into it, and it's going to be 5.75 right front, that's $5,750, $5,700 just gone, not compounding for you. And then if you look at the internal expenses, it may average 1.25%. So it's going to cost you darn near almost 7% that first year to have the pleasure of owning that mutual fund compared to owning ETFs, exchange-traded funds, or individual stocks. If you have enough assets in that particular account, that's going to be the cleanest, most tax-efficient, and most fee-effective way to build wealth.
So if I can, I just want to make a point. So that's where our licenses become very important. A broker is going to be selling you those loaded mutual funds. A fiduciary will not. Not dual registration.
Hybrid.
You are not going to have those loads, internal costs, 12B1 fees, advertising expenses, all of that. Not with us.
And just to be clear, a prospectus is really a booklet, and it's a booklet that the investment company has to follow when managing your money. That's kind of the rules and regulations that they adhere to and follow. So
typically they may send it to you in the beginning, but a lot of times clients are like, nope, I'll take your word for it, Mr. Broker. I'll buy this fund, and then the prospectus will come after the fact. And then
and
that
these
point
days
already
it's all
late.
digital.
Right.
So not
As long as
even
you
mailed
agree to
anymore, right?
Yeah, you got to know what you're getting.
Yeah, that's right. That's right. So you're absolutely right to ask the question. A prospectus, especially if you open the link to a prospectus or you have gotten it in the mail, incredibly confusing. So I think you want to go first and foremost to the fees, so you even understand what it is that you're paying. But when you get a 200-page or a 500-page booklet, you don't even know where to look to find the fees. So if you need some additional help, don't hesitate to contact us.
So a lot of times those mutual fund companies, they'll consolidate all their mutual funds into one prospectus, and then you get a hunt for yours.
Right. It can be confusing. And I think intentionally so. It's confusing.
Totally. Yeah. So and there's something called a redemption fee. They're going to charge you money to sell your asset. So that's a redemption.
That you've already paid a fee for it when you bought into it.
Yeah, exactly.
Next, we'll look at another place people hesitate to ask questions, and that's really about their tax professional. So if you're wondering whether your CPA is really planning with you or just plugging in numbers, send your situation to trajanwealth.com/5QIQ. A lot of listeners are asking some version of this question. How do I know if my CPA is proactive or just filing my return? If you mostly hear from your CPA between February and April, you'll want to hear this conversation. So let's dig into this.
So let's say that you have, last year you had to pay taxes and you're afraid this year that you're going to have to pay taxes again. And your CPA says, change your withholdings. That's not tax planning.
No.
Not even close.
That's lazy.
That's regurgitating numbers.
Yeah.
They send you out a questionnaire to fill out. You fill out your questionnaire. They probably have last year's numbers in there too. So you're filling out that whole questionnaire. You're sending it back to him. He's uploading it into his software.
Or her.
Or her. Uploading it into their software. And then they spit out your tax return and charge you a nice big fat bill, depending on how many schedules you have.
Right. Typically, you'll maybe see them once a year.
If even.
And if even that. So if you see your CPA, or maybe not even see me at all, you upload all your documents on a secure portal. They get back to you in a couple of weeks. Hey, everything's done. DocuSign them. They submit it for you. As compared to the team that we have here at Trajan Tax, and knowing that we have one of the representatives on a couple episodes ago, the ability to really do true tax strategy and planning. I'm going to be honest, from February to middle of April, it's going to be a little tough to do that. And the reality is, at that point of the year for last year, it's a little late. But for 2026, the ability for you to meet with someone on our tax team and do tax strategy and tax planning for 2026, whether that's Roth conversions or different things, that's where Marty and I can come in as a fiduciary advisor and say, yes, here's where Roth conversions could help you down the road. But the key thing is by having that tax team and fiduciary advisors, as well as if you need to do some ultra tax planning, utilizing estates and trusts, we have all those things here in your local family office and really utilizing all of the different resources we have available to you to give you a complete wealth management solution.
Okay, so somebody who might just be, a regurgitator of numbers, plug and play. Let's say that you thought you were maxing out your 401k because you put in enough money to get the company match. You don't realize that per our IRS tax code, you could have contributed much more.
Not really maxing out.
Right, per tax code. So one thing that a tax planner might be able to do is say, hey, if you open a traditional IRA right now, we can do a prior year's contribution to further reduce your taxable income. So that might be something that would be indicative, so you can go back and look and see, did you truly max out to IRS limits your 401k?
If you're available to do that, correct.
Right.
And if you're thinking about that question already, something in your gut is saying you're not getting planning.
Right.
Something in your gut is just saying he's preparing my taxes and that's it. So
exactly.
if you're already to that question, it's definitely worth a second opinion.
Yep.
And really, depending on the complexity, it's worth if your CPA needs to do a planning meeting at least once a year. And that's something that Trajan Tax does, is a planning meeting.
And typically you should do that like in the fall, so you've got time to do that before year end.
Because you get to year end and like Corbett said, it is a little bit too late. So great discussion. So let's talk about instilling financial wellness in our kids next. Our next listener asks, what's the best way to explain the value of investing to kids? If you've come across a great way to communicate this, we'd love to hear your thoughts as well at trajanwealth.com/5QIQ. So what do we say for the youth out there as far as investing is concerned?
Well, I think the biggest thing that I show for a lot of clients when they bring their kids in, and let's say they're 16, 17, they've got or $5,000, $10,000 saved up. And I'm like, look, here's how much you can have by using a time value calculator. Let's say, yep, you got $5,000, and let's say you save up for just for fun 40 years. The ability to put in, say, yep, and let's say you average $200 a month. To plug in that $200 a month for 40 years on that $5,000, the number is huge. And I'll ask them, how big do you think that number is? And a lot of times they're not even close. Then I show them the number on that calculator, and they're like, wow, I had no idea. Yeah, exactly. To your point earlier, Jeff, compound interest is truly the eighth wonder of the world, and knowing that you can have that work for you. Because for a lot of kids, they're like, $200 a month, whatever, da-da-da. No, $200 a month times 480 months, that can add up to some true wealth.
So I think the first step is to teach them the value of a dollar, to teach them how money actually works, because, it's elusive. We're in, a society that's instant gratification. Right. My iPhone broke. I'm just going to get another one. I need a coffee. I'm driving through Starbucks. Or Dutch. I think for kids, teenagers and stuff, it's more like Dutch Brothers to get the energy drinks. So until they really understand what the value of that $7 that they just paid for a drink is and what that could do for them in the future, they probably aren't going to, they'll look at the number and be like, oh yeah, that's $1 million, but it's so unattainable at this point and it doesn't make sense. Let's start small. Start small with, have the parents, if you're in a position to do so, open a Roth account for your kid, right? Throw it into a nice little ETF and let them open the statement. Let them see how that money is working little by little by little. And then when they get if you pay them an allowance or if they have a job and they're earning some money, say my expectation is that you are now going to contribute, $100 or $50 or even $10 into this account every month.
Or so you'll match it. That's what I did for my son.
And then I'm going to put money into to match that as well. So start small and then you're compounding that for them, right? You're now also compounding what they put in immediately. And then they can start seeing how that's starting to grow. I think another thing that's going to be phenomenal is this new savings account that...
Oh, the Trump accounts?
That's opening up. So right there, the kids are not going to be able to access that money at all. But now they're going to be able to see the power of compounding through that type of an account. But I much prefer one where they have skin in the game too, because unearned assets come with no respect.
Right. There's really 3 accounts that you can open up for kids, or at least that I did for my kids. I opened up, that a lot of people may have heard of, 529. It's specifically for college. Benefit of 529 is you can literally put as much as you want in there. Gross tax deferred. It comes out tax-free, assuming you use it for higher education.
And it can be used now for preparatory school.
Can be used for prep school, and you can roll it. If the child doesn't go to school, you can always roll it to another child, or give it to a grandkid or whatever.
Well, if they get a scholarship, you can take that money out. Match if they get a $10,000 scholarship, you can reduce the 529 plan by that money.
And one of the really cool things about with the Big Beautiful Bill Act was that if you've had the account for 15 years, you can convert $7,000 a year for 5 years or $35,000 into a Roth IRA.
Oh, that's right.
So if you are going to have excess funds, I mean, my son's 19, so we'll just say I oversaved in his 529 account. I had hoped for possibly Stanford, Harvard, and a little bit. That's a whole nother conversation. But the ability to know that I saved for it. Now, not all those funds are going to use. His sister is 13, so we'll see what that is. But needless to say, I'm able to take out that $35,000. The one goofy thing is that you have to do it over 5 years, so it's only $7,000 per year. Which I'm like, goofy, really? Right. So the ability to do that it's huge. Yeah. I mean, that gift of say 5 years from now, when he's 24, hey, you might have $50,000 from savings. I mean, from conversion to it and compounded growth. That's tax-free on a Roth from 24 to, let's say, 64, those 40 years. I mean, it's amazing.
But that's another account that you can open up for them. So when you open up for them and then give them their statements. Right. So a 529, college, a Roth, that's tax-free for retirement. But then another one that isn't too common out there is an UGMA. You're essentially giving a gift. So when you give a gift, it's a non-qualified account. So what that means is it just grows. It's taxable to them every year, but their income tax bracket is
depending on how much it kicks out. Now the other one too is the education savings account. This one's even a little less common, but it's only $2,000
than a 529,
right? Yeah. But because the biggest thing it's only $2,000 per year.
But the thing with the UGMA and the UTMA accounts is when they turn the age of majority in your state, so it might be 18 or 21, you have to retitle it in the name of that kiddo.
Right. It goes to that kid. Well, it becomes their money.
Yeah. Well, and you have.
So if they want to go out and blow it on a Porsche, they can't.
So there's advantages and disadvantages to all, but if you get them involved early, and then force them to invest into it, learn, force them to invest. $100 a month, $200 a month. Heck, I've got my kids up to $1,000+ a month, and they really couldn't afford it, but they have to adjust their lifestyle accordingly. Now, this next listener is looking beyond their own lifetime. And the question is, how do I build generational wealth for my family? Am I just too old to start? Now, if that question has crossed your mind, we'd love to hear your story at trajanwealth.com/5QIQ. So let's discuss that.
Never too old.
Never.
No.
No such thing.
Start. No such thing. Yeah.
Just have to start.
But I mean, I think probably the biggest thing is going to be, a trust. The ability to have that kind of that control and power for that, so that it doesn't get used frivolously. and for cockamamie things that they might buy in the future.
You're using a new word.
What a big word.
I know.
So what would you recommend a trust? So how much do they have to even have a trust? What
The dollar amount really doesn't matter. The key thing is the ability to know that it's
going somewhere?
It's going somewhere.
So you're talking
with
about
some restrictions.
preserving what they've accumulated.
Well, not so much preserving,
controlling the assets from
controlling
the
it.
grave.
Right. Exactly.
So how do they accumulate those assets? Like, what's the best way? What would you recommend as far as how to get there for savings?
Like I said, certainly, you want to have your emergency fund taken care of. I mean, that's the biggest thing, just in case something does happen.
Right.
And then if you have additional savings after that, Roth IRA is probably going to be your next best option.
Well, maxing out your retirement
401k.
account.
If you have a 401k.
If you have a 401k.
Or whatever
right.
kind of.
And I was thinking about more for like on kids, right? That's the main focus for us.
Well, no. I think I'm talking about like when I die, how can my assets continue to live on? How do I?
Or generational wealth. Okay.
Generational wealth.
Okay.
Yeah, at that point, not just for
not on the front side, on the back side. On the back side.
Your favorite side.
So,
and even if they are a little bit old, or even if you are a little bit old to start, it's for yourself. It might not be for you. It might be for your kids.
Yeah.
Right. Money that you are, what I consider what's called legacy money. Money that you are not going to need, money that you're willing to pass on, but also making sure that within that trust that it, like I said, being used frivolously, because like I said, you can do all the right things, and if it doesn't have the right controls within it, then you have no idea what's going to happen.
So I'm going to say plan for, and we talked about this on another episode. I said who's going to change your light bulb. Plan for the unforeseen. Maybe to protect your wealth now, get a long-term care insurance hybrid policy, so you know that policy can pay out, leaving your assets intact. Maybe look at using an irrevocable life insurance trust. Get some life insurance that's going to pass on to you. That's just a really easy way to pass on a large amount of money tax-free.
Absolutely.
And then through your trust, you can even allocate how that's to be inherited. Right?
Yeah.
So
and
you have
what it's to be used for.
And what it's to be used for. Who gets it, who doesn't get it. You can exclude whoever you want from, out of the trust.
Or like I said, put restrictions if there's addiction issues or things like that.
Yeah. So there are different tools that you can utilize in order to maybe get to where you think you want to be for your family.
But in your mind, do you think trust is that best option?
To help preserve that for future generations through distributions, yes.
Great.
But you have to get there first.
Right.
Great question. So let's finish with the question that hits almost everyone who finds a little extra at the end of the month. With occasional extra money, should it be put into my 401k, my IRA, a Roth, HSA, or a regular brokerage account first? Where do we even go? If that menu feels overwhelming to you, this really is your segment. So let's discuss that. Where do they go first? Where do they put that extra dollar?
So
send it to me.
Send it to Corbett.
Yep. Cash, please.
Yeah. Unmarked bills.
Unmarked bills in an envelope, please.
Bitcoin.
Yeah.
Oh, geez.
It's on sale right now.
So I'm going to say we would have to look at your current financial picture.
Right.
Do you have the emergency funds? Do you have additional savings? Have you maxed out your 401k plan? Have you maxed out?
Is there a near-term goal that you're trying to save for?
Right. So once you've hit those, HSA, max that bad boy out. If you haven't already.
Which one do you think would be better to max out? 401k or the HSA?
401k, well, depending on how old they are, how close they are to retiring.
Like you should probably max out on the HSA because you're close to retirement.
I should, because I'm super close to getting away from you.
Thank God.
Yeah.
The ability to, like I said, Marty brings up a good point, is age. If you're younger, the 401k is going to be a better option because it's more for retirement. If you are within, I don't know, say 5-10 years of retirement, then yeah, beefing up kind of both, but beefing up the HSA side, because the cool part with the HSA side is that medical expenses, deductibles, all those things can be met through HSA and still be invested.
Mm-hmm.
So having that flexibility is awesome without having to say, okay, yep, I didn't put anything into the HSA. I put everything into the 401k. Oh, everything comes out taxable on this part. And I didn't even think about that, medical expenses and things like that.
Right.
Or that can be utilized on the HSA side.
Mm-hmm.
And it grows tax deferred.
Right.
Mm-hmm.
Mm-hmm.
And the 401k, Roth or traditional?
For me personally, I do 50-50. I do half of my contribution in pre-tax, half in Roth. That way I can't be 100% wrong. Knowing,
Or can you?
Not with that type of situation. But, the same thing. Could I use the tax break? Sure.
Yeah.
But, Marty and I and you, Jeff, as well, have done that calculation enough for RMDs that, that huge number scares the bejesus out of me. And having the ability to be tax-free because, as I mentioned in an earlier episode, taxes in my mind only can go up in the future. You know what I mean?
Yes, they
So
can.
if we can control that and have more tax-free income later on down the road, then fantastic.
Yeah.
Always been a big advocate.
Yep.
Only thing tax-free out there, put as much
As long as you can, because they keep trying to get rid of it. There's
Yeah.
always a bill.
And someday someday they're probably gonna say, okay, enough is enough. We're not gonna do this
Right.
anymore. We're gonna grandfather everybody else that's in it already,
Mhm.
and then that's it.
Today, we tackled some great questions. What to look for when you get a new prospectus. How to tell if your CPA is truly proactive. What taxes might hit your kids' inheritance. How to start building generational wealth, even if you're later in life. And where that net extra dollar really should go. Which one sounds like your life right now? Tell us at trajanwealth.com/5QIQ. And thank you to everyone who sent in today's questions. Share this episode with someone who's saving and investing but isn't sure they're doing it in the best order. Plan smarter, dream bigger. One better decision with your money today? Well, that can echo for decades in your life and your families. Whether this was your first time with us or if you've been with us from the start, thank you for being a part of 5QIQ Financial Power-Ups with Trajan Wealth. We really do appreciate your time, and we will see you all again very soon.
Trajan Wealth, an SEC-registered investment advisor. Additional services through Trajan Estate and Trajan Tax. Information discussed during this program is intended for illustrative and entertainment purposes and is not investment advice or an offer to buy or sell any investment. Please consult your financial advisor for questions about your financial situation. All investments involve risk and the potential for loss. Any examples given are strictly hypothetical. Your results may vary. Additional disclosures at trajanwealth.com.